Welcome back to the channel. Today I'm going to be talking about the stock repair strategy. This option strategy is very powerful because it reduces your break-even point without taking on any additional risk.
Not a financial advisor. Any information included in this video is for informational and entertainment purposes only. It is not intended to be investment advice. Please seek a licensed professional for investment, tax, or legal advice.
So you bought a stock and the price drops. What are your options? Obviously, you can hold and hope things come back up for you, but you know this could take a long time to recoup your money. Another option that traders love to do is to double down. This reduces your break-even point, but it also increases your downside risk. This could be a valid strategy in some scenarios, but not always, such as when you have limited cash available. You could also sell a covered call above your cost basis, but sometimes that will only net you a few cents and will cap your upside potential without lowering your cost base as much. This is why stock repair strategy is perfect. It can be used to repair your stock position even if you're running the wheel. This is a strategy to use when you're short-term bullish or don't mind holding the shares. If you think stock is going to continue to go down, then your best bet may be to sell the shares and move on to a different trade. From my research, this works best when the stocks are down about 15 to 25%. This is because you may receive a credit for putting on this position, or the debit you were paid will be minimal, perhaps just a few dollars. Also, your goal should have changed from making money on this position to just getting out at break even, or maybe a small loss or slight gain. You're going to be setting up this ratio spread, but don't let the name make it sound too complicated for you, because it's really not. All you're doing are buying one call, preferably at the money or slightly out of the money, and then selling two calls at a higher strike where the premium received from the two short calls is about equal to the cost of the long call. If you can get this done with a credit, then you turn the strategy into an automatic winner if the alternative was that you were just going to hold the stock and hope for a recovery. It might help to understand how the strategy works by thinking of it as two different positions. Here you can see the shares you have and the three option contracts that you are in as well. Now we can break this up and look at it as though it's a covered call and a bull call spread. If you know how these plays work, then you already know how to manage this position. Hint, it's pretty easy. This is what the P&L looks like when you set up the options trade if you don't account for the shares that you own. As you can see, your downside risk is limited, and that is because the most you can lose is the credit you pay to enter this trade. Sometimes you can craft this trade so that you receive a small credit, in which case the max loss that you have is actually a gain for you, which is pretty cool. This really boils down to just how far out of the money the calls that you're selling on this position are. This is why I have found running this strategy when the stock is down 15 to 25% tends to be the sweet spot. If it's down more than that, you might not be able to set this up as a credit, but even then, you should be able to set this up for a small debit, maybe such as a debit for like $9 to put on this play. When you add in the shares that you own, this is what the P&L looks like. You will notice that to the upside, you're now capped at how much you can gain. This is because both short calls will limit the gains your long call and 100 shares can get. The other thing you will see is that you can still lose money if the price goes down. But Thumper, you said this was a risk-free trade. Well, the options play can be, but you can still lose money from the shares that you own, because those can still lose value and will move 1-to-1 depending on the price as it moves. Looking at this graph here, you can clearly see how beneficial this strategy is. The red line is the shares that you own, and the purple line is what it looks like after you put on these option contracts. Look at the break-evens between the two lines. Your shares without the strategy would have a break-even at about $29. But with the strategy, your break-even is only about 20 now. That's a huge difference in how much that stock price needs to move up for you to get out of this trade with at least break-even. And this is because between the two strike prices that you sell the call at and buy the call at, you're now long two 100 delta positions, which means that you gain twice as fast than had you only had 100 delta position if you just own the shares. Alright, so I'm going to show you an example of how to put this on. I'm going to do this on Wish. So I'm going to assume I have 800 shares that I bought at, let's say, $8.50. So we're really down. It's even more than 20%. But I think we can still get this play to show an example here. And I'm going to go out about a month and a half or so. You can go out, the further out in time you go, the better chance you have to set this up for a credit. So I'm just going to choose 41 days here. And I'm going to buy a call that's either at the money or one strike out of the money. So I'm just going to go ahead and buy this call. We'll figure out that we're going to get filled at about mid-price here. And then I want to find a call where I get back a majority of that times 2. So 34 times 2 is more than 66. So I'm going to go ahead and sell 2 of these. And we'll say we get filled at mid-price. And put 2 of these guys on. And I'm going to go to the risk profile, and you can see this is what it looks like. My shares I bought at 850, so my break even without this position would be right here. But with the option trade, my break even is now at 749 instead of 850. So we lowered my break even point an entire dollar. And we still have some upside up until we get to that 8 strike that we sold. And we can make $103 overall on this position. And we increase our likelihood to get out of this position by lowering the cost basis of the shares. That's pretty cool. We added no additional risk for doing this. Well, so for doing this, it looks like we actually paid a debit of $3. So the only risk we added to this position was that we might lose another $3 by putting this on. But we reduced our break-even point by an entire dollar. That's how powerful this strategy is, and I think everyone should know about it. Whether you're doing this out in a wheel or a dividend stock, you can run this strategy because you own the shares, so might as well earn some credit here. So here's another example. I'm going to do an Apple, but instead of buying at the money call, we're going to buy in further out of the money call and sell calls above that strike. So let me go ahead and buy 100 shares of Apple real quick. And I'm going to say that we bought this at like the top, and I think that was like 157.50. So I'm going to put that in. And I'm going to go ahead and buy the 165 call. So that's even above our stock price here. Go one further down and sell 2 of these guys. And if I go to the risk profile, this is what it looks like. Same general concept here, except you can see we have a lot more potential up here. If the stock runs past 170, we make $1,700. And this play, actually, no matter what, these option plays here, we got $8 credit for putting this on. So we're eliminating our upside on the stock to whatever happens up to 170, but we receive a small credit on this scenario, so this is basically a free trade to put on if you don't mind missing the upside of Apple going past 170. But since Apple's at 140 and we bought at 157, this is pretty cool because it also brings down our break even a little bit. Alright, if you like this video, go ahead and subscribe. Click that thumbs up, it really does help grow this channel. And if you want to learn more about options play similar to this, go ahead and click this video link here. This is going to tell you about a zebra play, which is really interesting. Go ahead and watch that, and